Welcome to another episode on Real Estate News. Today we'll delve into the recent regional banking turmoil, and we'll discuss the situations surrounding the First Republic Bank, its takeover by JP Morgan, and the potential implications for the real estate market. So, let's dive in. First Republic Bank, a mid-sized bank located in San Francisco, was recently taken over by the FDIC and sold to JP Morgan, making it the third U.S. bank to come under FDIC receivership and the fourth to fail in less than a month. This event has raised concerns about the stability of other regional banks and the overall U.S. banking sector. But first, how did First Republic Bank end up in this situation? First Republic Bank came under the spotlight after the collapse of Silicon Valley Bank, when it received a $1 billion deposit from industry players as a show of confidence. However, despite these efforts, the bank experienced a net decline of 4.9% from its year-end deposit balance after a massive withdrawal of customer deposits during the collapse of Silicon Valley Bank in March. To mitigate the situation, First Republic Bank announced strategic alternatives such as selling off assets, reducing reliance on uninsured deposits, reducing borrowings, and laying off a quarter of its workforce. However, these measures were not enough to prevent its eventual takeover by JP Morgan. Why did First Bank fail? First Republic Bank's failure can be attributed to several factors, including a high amount of uninsured deposits and a large mortgage portfolio with long-term assets. The bank's exposure to long-term assets, such as mortgages, make it vulnerable to market fluctuations and increasing interest rates, leading to a decrease in the value of these assets. The bank's inability to sell these assets to meet withdrawal demands led to an increase in short-term borrowing, which was facilitated by the Federal Reserve's discount window. This temporary solution, however, was not enough to save the bank from FDIC receivership. What does this mean for other regional banks? While the First Republic Bank situation is certainly concerning, it's important to note that other regional banks have not been hit as hard so far. For instance, PacWest Bancorp experienced a 7.4% hit on deposit withdrawals, but 3/4 of its deposits were covered by FDIC's insurance. It's possible that the First Republic Bank's earnings release and subsequent failure could prompt another wave of withdrawals, but it's too early to tell. In the meantime, it's essential to avoid wild speculations and focus on the facts at hand. So, how does the fall of First Republic Bank affect the real estate market? In a surprising turn of events, First Republic Bank's absorption by JP Morgan led to a noticeable jump in mortgage interest rates. As of the time of this recording, the interest rate for a 30-year fixed-rate mortgage is 6.58%. Now, you might be wondering why this has happened, given that a bank failure usually results in investors seeking safer investment options, leading to lower mortgage rates. Well, let's break down the situation and see what makes it different. Typically, when a bank fails, investors flock to safer havens such as bonds. When more investors buy bonds, their yields or rates decrease. However, this time around, the dynamic didn't quite play out the same way. The reason for this is that investors were already well aware that First Republic Bank was beyond saving. In fact, this became abundantly clear last Tuesday, which is one of the reasons rates moved lower at that time. It is important to understand that there are different levels of failure, and the outcome for First Republic Bank was one of the more palatable versions. In other words, the situation didn't end up as badly as it could have, allowing investors to lighten up on the bonds they had previously purchased for safety. So, how did this affect mortgage rates? Well, the week started with rates rising, as investors moved away from the previously purchased bonds. But it didn't stop there. A key economic report on the manufacturing sector came in stronger than expected, which further pushed rates higher. As a general rule, strong economic data tends to put upward pressure on rates. The outcome of all of this was the average lender moved at least 1/8% higher for a conventional 30-year fixed mortgage. The recent increase in mortgage rates resulting from the fall of First Republic Bank has significant implications for both buyers and sellers in the real estate market. So let's explore the real-world impact of the increased mortgage rates on the housing market and discuss how buyers and sellers can navigate this new landscape. For buyers, this can mean higher monthly payments and potentially having to settle for a smaller or less expensive home than they had originally planned. For example, a $500,000 mortgage at a 6% interest rate could have a monthly core payment of $2,998, while the same mortgage at the current rate of 6.58% would have a monthly payment of $3,181. This may not seem like a significant increase, but over the lifespan of a loan, the borrower would end up paying over $28,000 more in interest. The increased mortgage rates may also limit the amount of homes that the buyer can afford. For instance, a buyer who can afford a monthly mortgage payment of $1,500 at a 6% interest rate can only afford a mortgage of approximately $250,000, assuming a 30-year loan. If the interest rate increased to 6.58% and the buyer still aims for a monthly payment of $1,500, they can now only afford a mortgage of approximately $227,380, also assuming a 30-year loan. Consequently, this buyer can now afford a house that is $22,655 less than before. In some markets, this drop in buying power may have a considerable impact and may reduce the availability of homes to potential buyers, as buyers may be less willing or able to purchase homes at a higher interest rate. This decrease in demand may lead to a decrease in home prices, which could negatively impact sellers who are looking to sell their homes quickly or for a high price. However, it is important to note that the impact of the increased mortgage rates on sellers may be limited in certain markets. For example, in some areas with low inventory of homes for sale, sellers may still be able to command a high price for their homes, even if demand is slightly lower. Additionally, sellers who are not in a hurry to sell their homes may be able to wait out the current market conditions and sell their homes at a later date when interest rates are lower. One potential silver lining for both buyers and sellers is that the increased mortgage rates may lead to a decrease in competition for homes. In a market with high demand and low inventory, buyers may be forced to compete with each other and offer more for homes in order to secure a purchase. With fewer buyers in the market, however, buyers may be able to negotiate lower prices for homes and face less competition from other buyers. In either case, working with a knowledgeable mortgage professional can help you navigate these complex market dynamics and make the best decision for your unique situation. That's all for today's update on the recent First Republic Bank situation and its impact on mortgage rates. Keep an eye out on the market and stay informed with the latest real estate news right here on our channel. If you found this video helpful, please give it a thumbs up and don't forget to share it with your friends and colleagues. Until next time, happy house hunting and selling!